Interesting time in the history of the United States to be tasked with performing an economic analysis. The effects of COVID 19 continue to break records across many sectors in our economy. I will briefly talk about the effects of COVID 19 that has had on our economy and then continue on to talk about our present situation in context of the pandemic. COVID came in at a time where our economy was doing great. Consumer spending was higher than ever, domestic investment was at an all time high, and our GDP continued to climb. Conversely, government spending was high but wasn't completely out of control, and our net exports were diving further into the red. However, consumer sentiment for our economy was better than it had ever been since 2004. It was certainly a time of economic expansion. When COVID hit, the economy came to a grinding halt. Americans stayed in their homes, causing stats across nearly every metric to plummet at a rate unlike anything we've seen in recorded history. Three notable exceptions, of course, are the unemployment rate, e-commerce retail sales, and total government spending, which skyrocketed to new highs. Overall, domestic investment was down 18% from its previous high, GDP was down 10.2% from its previous high, and net exports, which was seeing its first upward trajectory since 2012, was completely reversed back downward. Using that background as a lens, we will be looking at the current state of consumption, investment, government spending, and net exports throughout the remainder of this economic analysis. First, let's look at how consumption is playing out nationally. One of the most telling metrics is retail sales. Overall sales plummeted 19% in the months after the pandemic first hit. This was caused by Americans staying home. E-commerce sales, which had been growing at a steady pace since 2000, jumped from 11% to 16% of total sales. This, of course, was not enough to make up for the overall drop in retail sales, but is worth noting that the pandemic accelerated the trend of e-commerce. Since the initial drop in quarter one of 2020, retail sales have bounced back with a vengeance, not only making up for lost sales, but surpassing the growth rate of the previous trend. In March 2021, we had a record number of retail sales. Why is this? We can suppose that pent-up demand was finally let loose as consumers felt more comfortable leaving their homes. More telling, however, is the disposable personal income grew significantly on the onset of the pandemic and gradually fell back to normal levels and then exploded to record highs by March 2021. This correlates very closely with our data on retail sales and GDP. Where did the sudden increase of disposable income come from? Let's start by looking at unemployment. We can see that unemployment skyrocketed to a record high of nearly 15% at the onset of the pandemic. 1 year later, it's greatly recovered, but only to 6.1%, nearly double what it was before the pandemic. How interesting that even though unemployment numbers are up, disposable income is at an all-time high. Has our society finally achieved the level of prosperity and celestial glory that we no longer need to work to survive? Nope. The true answer to this phenomenon can be seen in our government spending graph. As you can see, it is also at an all-time high due to increased government spending to bolster the economy during the pandemic through stimulus payments to individuals and businesses. At the same time that stimulus checks roll out, personal disposable income goes up. This is partly why retail sales have been breaking records even before the pandemic is considered officially over. Whether or not it was the right move for the government to spend so much on stimulus payments remains up for debate. One thing is for sure, that the government cannot continue to issue large funds of cash if it ever hopes to maintain a healthy economy. A big negative consequence of these stimulus payments is that it makes sense for some families to continue to stay home from work in a world where they get paid to stay at home. Currently, job openings are up, while unemployment remains very high. In fact, there are more job openings today than there were before the pandemic. This is because it makes more sense for families to remain unemployed and collect huge unemployment checks. Economists expected unemployment to drop to pre-pandemic levels and were shocked to see the high rates of unemployment despite a huge increase in job openings. Another big scare of increased unemployment benefits and stimulus checks is that the rate of inflation will spiral upward out of control. According to the Consumer Price Index published by the Bureau of Labor Statistics, we saw an annual rate of 4.2% increase in prices from April of 2020 to April of 2021, which is double what most economists say is a healthy inflation rate for the US. However, there are many other factors driving inflation other than increased stimulus checks, primarily demand and restricted supply of energy commodities. The price of gas has regular gas that you go get at the gas station has increased 49.6% over an annual period ending in April due to increased travel. People have places to go, and now that the economy is back up, and road trip season is just around the corner. Also, of course, it's not just demand that's causing this huge price hike, it's also supply. The OPEC oil cartel is keeping a lid on output, and US oil companies have voluntarily kept their production low because when oil is more scarce, it's more profitable. In line with this trend, we also see the price for used cars and trucks increase by 21% from a year earlier. Used car sales are up to record highs due to the temporary closure of car manufacturing across the globe, which continue to struggle to keep up with demand due to material shortages and lack of labor. And here's a graph of just to show you that Americans did stop traveling and are back on the road. And another graph to just kind of give you an idea for what used car sales are doing. It's incredible how much it's skyrocketed in the past, just the past quarter. All right, so that's the consumption side of things. We'll now move on to investment. Gross private domestic investment has bounced back net positive since the pandemic. According to a survey by the University of Michigan, consumer sentiment had completely recovered in the decade following the 2008 financial crisis. This hard-won confidence dropped to levels not seen since 2013, on the outset of the pandemic. Sentiment has since recovered by 13%, which means investors are feeling more optimistic about the future state of the economy. These two metrics are only loosely tied. If overall consumer sentiment is high, consumers are more likely to purchase goods and services, which in turn requires businesses to grow. Investors supply the additional capital these businesses need to meet consumer demand. However, the rate of domestic investment has far outpaced the rate of consumer sentiment. So, what's driving this growth? I believe that it is demand itself that is requiring businesses to grow. Pent-up demand from COVID-19 is driving a huge bounce back in economic activity, and many businesses are working overtime to keep up. Foreign direct investment in the US is still a net positive, but hasn't made a full comeback from before the pandemic. I do predict that foreign investment in the US will raise back to pre-pandemic levels as borders begin to reopen. Continuing on with investment, private residential fixed investment is actually at an all-time high. The demand for housing is so strong that developers can't keep up. We are seeing more new construction of privately owned housing units since 2006. But houses are being bought up faster than they can be built. In fact, according to Redfin's CEO, Glenn Kelman, there are now more realtors than listings. It really is incredible just looking at this graph how much inventory has dipped since October through today. It looks like it's coming back up. We hope so, because housing prices are incredibly high right now, and it's actually taking a lot of people out of the housing market because they simply can't afford it. Naturally, when you have demand this great, prices start to go up. The average sale price for a home is up by 21.5% since the previous record was set in 2007, right before the Great Recession. Also, not helping is the cost of materials to build these new homes. The cost of lumber alone has doubled pre-pandemic levels due to an artificial constriction of supply. And the cost of labor is rising as contractors are having to pay a premium just to get workers to show up on the job. So not only is private fixed residential investment at an all-time high because of the surge in demand, but prices are compounded by the fact that the contractors have to pay higher prices to build these homes. Eventually, home prices will outpace the price at which homeowner hopefuls can afford, and construction will begin to ease. At least the rate of construction will begin to lower until prices finally soften, calm back down, get back to normal levels. Eventually, we'll make it out of this okay. Overall, the data we have on private investment in the United States shows us that our economy is bouncing back from the pandemic stronger than anticipated. It's likely that investment it's likely to continue growing for another year until supply finally surpasses demand, resulting, I think, in an oversupply and therefore decreased investment. That's kind of how these cycles go. But of course, in this case, this cycle is getting exaggerated by the effects of the pandemic. As far as investment in housing is concerned, I think that we are still feeling the repercussions of the 2007 housing bubble. Since there was a huge oversupply back in 2007 of homes when the market first crashed, many contractors left the market or reduced their number of building projects. Demand began to pick up over time, of course, but contractors were either afraid to build or there weren't as many contractors. Basically, they failed to keep up with demand ever since 2007. And now, because of the pandemic, there was demand. So they were already behind the demand curve. And then once the pandemic hit, the housing market just exploded across the United States. People were leaving the cities and moving out to the suburbs, and developers were not prepared. So I think that explains the huge housing crisis we're having. I think the housing market will continue to behave radically until there is finally an oversupply of housing. In Utah, that may not be for several years, and local economists speculate that the Utah housing market is short about 40,000 homes. We'll now move on to government spending. As previously mentioned, government spending is at an all-time high due to stimulus payments and unemployment checks. There are two very discernible spikes in spending in quarter 3 of 2020 and quarter 1 of 2021, the same time when everyone received their stimulus payments. Spending jumped from $7.5 trillion in quarter 1 of 2020 to $10.9 trillion in quarter 2 of 2020, by far the largest increase in government spending in U.S. history. While government spending increased, revenue dropped as taxpayers were laid off from work. Consequently, the deficit also broke records into the negative. Government spending at this rate is unsustainable, but then again, that's what Republicans have been saying for decades now. Modern monetary economic theory suggests that the government can continue to spend more than it brings in as long as it can maintain a healthy inflation rate. And what we're seeing today is about a 4.2% inflation rate. A healthy inflation rate is more closer to 2%, according to most economists. But modern economic theory has yet to be disproven. In fact, it seems like we've been validating it this whole time as we continue to spend more and more and more money. And even now, with these huge increases in government spending, our economy is still surviving, if not thriving. So I would argue that modern economic theory has yet to be disproven. However, it's a really risky bet, as our nation's financial health is now completely reliant on exorbitant government spending. And, hitting deficits every year. I'd predict that the rate of government spending will level off and even out as officials realize that they are restraining the growth of the economy by paying workers to stay home by paying them with stimulus payments. Despite all this, public concern about the government deficit is actually falling up till June 2020. These numbers come from Pew, and this is actually really surprising to me considering the fact that, the deficit is just about as worse as it ever has been. It's much worse than it ever has been. Our last section is all about net exports. Net exports continue to spiral downward further into the negative. as we make our way through the remaining months of this pandemic. Every recession since 1990 has caused exports to climb, as we can see here in early 2000. It lowered and climbed back up. It really climbed up in after the 2008 financial crisis. And actually, looking back, I wish I had taken a better screenshot of just a longer history of this graph, because it shows that ever since 1990, there's pretty much always a huge increase in net exports during a recession. But this recession over here that we're having now seems to be quite a bit different. Net exports in Q1 of 2021 was nearly twice as low as Q1 of 2020, a year earlier. And this is probably an effect of American manufacturing plants shutting down because of the pandemic. Even though a lot are back up and running, many are so far behind in their production schedules that it could take years for them to catch up. I do expect our net exports to level out to previous levels in the near future. This has been an economic analysis by Mitchell Smedley for Finance 4100.